Good morning to one and all. First of all, let me introduce myself. My name is Shrivant, and I'm a student of WIT AP. Like many of you, I first heard of blockchain through Bitcoin, but what really captivated me was the underlying technology, the way it uses cryptography to build an unshakable foundation of trust. The most important thing we should know is ledgers to know how blockchain works. Today we are going to learn about origin of ledgers. The main learning outcome of this session is tracing the evolution of ledgers from traditional to distributed. By the end of the session, you will be able to trace the evolution from traditional to distributed ledgers. Understand the fundamental purpose and function of ledgers. Identify the limitations of centralized ledger systems. Explain how distributed ledgers address traditional challenges. Analyze the key innovations that enable distributed ledger technology. Understanding the core concepts of a ledger. 1. The core purpose, systematic recording. A ledger is a book or digital record used to store and organize financial transactions of a business or individual in a systematic way. Deeper meaning, the term systematic is crucial. It means the ledger isn't just a random list of notes. It organizes transactions by account type, e.g., cash, rent expense, accounts payable. This organization allows a business to quickly answer specific financial questions, like, how much cash do we have right now? Or, how much have we spent on rent this year? It transforms raw data into useful information. 2. The mechanism, debit, credit, and balance. The example highlights the core mechanism of bookkeeping: debit, amount, credit, amount, balance. Deeper meaning, the T account. Every account in a ledger is structured like a T, called a T account. The debit side is always the left, and the credit side is always the right. The golden rule. The fundamental principle is that for every transaction, the total debits must equal the total credits. This ensures the system remains in balance, which is the foundation of the double entry system. Effect on balance. Whether a debit or credit increases or decreases an account depends on the account type, e.g., a debit increases an asset account like cash, but a credit increases a liability account like loans payable. Balance. This is the net result of all the debits and credits recorded in that specific account. It tells you the final status of that account at any given time. 3. The role, book of final entry. A ledger is also called the book of final entry because it contains all the information needed to prepare financial statements. Deeper meaning, journal versus ledger. This clarifies the ledger's place in the accounting cycle. Journal, book of original entry. This is where transactions are first recorded chronologically, like a daily diary. Ledger, book of final entry. This is where the summarized data from the journal is posted, transferred, and categorized by individual account. The outcome, the final balances in the ledger's accounts, assets, liabilities, etc., are the only figures needed to construct the three major financial statements: balance sheet, income statement, and cash flow statement. It is the definitive, summarized source of financial truth for the business. Would you like a brief explanation? History of traditional ledgers, a 5,000-year journey. The image provided outlines the history of the ledger, demonstrating a foundational shift in record keeping over 5,000 years, moving from a trust-based system to a mathematics-based one. This evolution highlights two critical eras in accounting history. 1. 3000 BCE, clay tablets, the first ledgers, era. Key development. Characteristics: 3000 BCE. Clay tablets. The first known ledgers used by ancient Mesopotamians to record transactions and debts. They were physical and limited to local transactions. Detail. This represents the absolute starting point of organized financial record keeping. The Mesopotamians, needing to track agricultural surplus, trade, and debts, used clay tablets as their physical books. Significance. While rudimentary and localized, these tablets established the fundamental need to track transactions and obligations, debts, laying the groundwork for all future accounting systems. The records were inherently limited because they relied on the local system of trust and did not contain a comprehensive, standardized method for ensuring mathematical accuracy across all accounts. 2. 1400s, double-entry bookkeeping, the modern foundation, era. Key development. Characteristics: 1400s. Double-entry bookkeeping. Italian merchants created a self-balancing system where every transaction is recorded twice, debit and credit, forming the foundation of modern accounting. Detail. This period, primarily centered around Italian merchants during the Renaissance, brought about the revolutionary double-entry bookkeeping system. This system requires that for every economic event, the total debits must equal the total credits. Significance: this was the crucial shift from trust-based to mathematics-based record keeping. The self-balancing nature of double entry means that the system itself acts as a mathematical control. If the total debits do not equal the total credits across all accounts, an error exists. This innovation made accounting records far more reliable, standardized, and scalable, enabling the growth of complex international trade and modern business structures. The evolution from simple clay tablets recording a single event to the comprehensive, interconnected system of double-entry bookkeeping represents the birth of modern accounting, transforming raw data into reliable, verifiable financial information. Centralized ledgers, traditional systems. The image details the evolution of ledgers into centralized systems, a phase driven by the need for efficiency and scale achieved through the use of trusted intermediaries, like banks and large corporations. This period is marked by two key developments. 1. 1600s–1800s, banking systems. Era. Key development. System characteristics 1600s to 1800s. Banking systems. Central and commercial banks established centralized ledgers, creating a trusted third-party intermediary for standardized accounting. Detail. This era saw the rise of modern central banks and commercial banking institutions. Prior to this, accounting was often done internally by merchants. The banking system introduced a trusted, professional third party to handle a significant portion of the ledger work, such as managing deposits, loans, and international settlements. Significance: centralization. Banks became the single source of truth for financial records for their customers. Standardization. This promoted a standardized approach to accounting and record keeping, necessary for cross-border trade and large-scale economies. Intermediation. It institutionalized the role of the intermediary, where trust was placed in the bank's ability to accurately and securely maintain the ledger. 2. 1950s–1990s, digital ledgers. Era. Key development. System characteristics 1950s to 1990s. Digital ledgers. Computer systems enabled electronic record keeping, automating processing, calculations, and reporting. The system, however, remained centralized. Detail. The introduction of computer systems and electronic databases revolutionized the mechanism of record keeping. The physical book ledger was largely replaced by digital ledgers, databases. This dramatically increased the speed, accuracy, and processing power of accounting. Significance: automation. Tasks like calculating balances, generating reports, and reconciling accounts became automated, leading to massive gains in efficiency and scale. Scalability. Businesses could manage billions of transactions far more easily than ever before. Persistence of centralization. Crucially, the fundamental structure remained centralized. The ledger was still controlled by a single entity, a bank, a corporation, or a government treasury. The efficiency improved, but the dependence on a trusted intermediary was unchanged. This evolutionary phase set the stage for the next major development, as the efficiency gains of digitalization contrasted with the inherent security and transparency limitations of maintaining a single, central point of control. Limitations of traditional centralized ledgers. The image highlights the inherent weaknesses of traditional, centralized record-keeping systems, where a single entity, like a bank or a corporation, maintains the ledger. The heavy reliance on one trusted authority creates vulnerabilities that ultimately led to the development of a new, decentralized model. 1. Single point of failure. Detail. Because a central system stores all data and controls all operations, any disruption to that system affects everyone. Implication. System downtime, e.g., a server crash, immediately halts services for all users. More critically, a successful cyber attack or catastrophic data loss at that single center can permanently compromise or erase the entire system's history and current status. This represents a massive risk of catastrophic data loss. 2. Trust requirements. Detail. Users must inherently trust the central authority, the bank, government, or corporation, to be honest, competent, and secure. Implication. The central authority has the unilateral power to modify or reverse transactions without external consensus. This lack of checks and balances means that users are completely dependent on the central party's integrity, raising concerns about potential fraud, error, or censorship. 3. Limited transparency. Detail. In centralized ledgers, users are typically granted visibility only into their own transactions and account balances. Implication. They lack visibility into the overall system operations, the ledger's entirety, or the processes used to validate and reconcile transactions. This makes independent verification of the ledger's integrity virtually impossible for users and promotes an information asymmetry between the central authority and its users. 4. High costs. Detail. Maintaining a complex centralized infrastructure involves significant overhead. Implication. These costs are passed on to the user in the form of intermediary fees, e.g., transaction fees, maintenance fees, overdraft fees. Specifically, cross-border transaction fees are often high due to the complex network of correspondent banks required to coordinate the centralized ledgers of different nations. This makes the system expensive and often inefficient, particularly for small value or international transactions. These vulnerabilities, risk of failure, reliance on trust, lack of transparency, and high cost, are the primary drivers behind the search for distributed ledger technology, DLT, which aims to address these limitations. The shift to distributed ledgers, DLT, the image details the crucial transition from centralized record keeping, where a single party controls the data, to distributed ledger technology, DLT, which is the foundational technology behind cryptocurrencies like Bitcoin. The breakthrough moment. The need for a new system was crystallized by the 2008 financial crisis. This crisis exposed the systemic risks, vulnerabilities, and lack of transparency inherent in heavily centralized financial systems. This dissatisfaction led directly to the proposal of the first practical distributed ledger model, the Bitcoin white paper in 2008. This document introduced a solution that addressed the limitations of traditional ledgers by eliminating the need for trust in an authority. Fundamental shift, trust in code. The move to DLT marks a fundamental shift. Instead of relying on an authority, a trusted third party like a bank, the system relies on code and cryptography to ensure integrity and security. DLT, distributed ledger technology, eliminates the need for trusted intermediaries by leveraging three core innovations, key innovations enabling DLT. 1. Cryptographic security. Mechanism. DLT uses advanced cryptographic tools, specifically hash functions and digital signatures. Function. Hash functions create a unique, tamper-proof fingerprint for a block of data. If even one character in the data is changed, the hash changes completely, making tampering immediately obvious. Digital signatures ensure that a transaction truly originated from the authorized owner. Goal: to ensure data integrity and verifiable ownership without relying on a central administrator. 2. Consensus mechanisms. Mechanism. These are algorithms, e.g., proof of work, proof of stake, that define the rules for the network. Function. They allow a large number of distributed, independent parties, nodes, to agree on the validity of transactions and the correct order of the ledger's history. No single party can unilaterally approve a transaction or change the ledger. Goal: to establish a single, verifiable source of truth across a decentralized network. 3. Peer-to-peer, P2P, networks. Mechanism. This network structure connects participants directly to each other. Function. It enables decentralized communication and data sharing without central servers. Every participating computer, node, holds a copy of the ledger. Goal: to eliminate the single point of failure that plagues centralized systems. If one computer goes down, the network and the data remain intact on the thousands of other copies. In summary, DLT uses these three innovations to create a system that is transparent, secure, censorship-resistant, and can operate without traditional banks or governments acting as intermediaries. Traditional vs. distributed ledgers. Aspect. Traditional ledgers. Distributed ledgers. Control. Centralized authority. Decentralized network. Trust model. Trust in central party. Trust in mathematics, cryptography. Transparency. Limited visibility. Full transparency, public ledgers, failure risk. Single point of failure. Distributed resilience. Transaction speed. Fast, centralized processing, varies, consensus dependent, costs. Intermediary fees. Network fees, typically lower, accessibility. Requires account, permission. Open access, public networks. Thank you for giving this opportunity to present.